Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Amazon shares drop after announcing plans to spend $200 billion this year on data centers, chips, and other equipment.
Meanwhile, Bitcoin rebounds, having plummeted on Thursday when it neared the $60,000 level.
And we break down more tech earnings with the CEOs of Roblox, Affirm, and the Warner Music Group.
But first, we check in on what is a tentative bounce back after what has been a punishing week. Remember, the Nasdaq is on track for its worst week, Ed, in 3 months since the beginning of November. But now we see a little bit of a reprieve, a little bit of dip buying. We're up a percentage point if you're looking at the big indexes. And I know you're going to drill into the individual movers that push and pull. But crypto, up almost 9%, but only about eradicating half of yesterday's losses. We're still only at 68,000. What a remarkable beginning to the year for this asset class that in many ways people feel is not a store of value. But what are you looking at?
The analysts are calling it sticker shock. Amazon pledging to spend $200 billion capital expenditures on AI infrastructure. The stock down more than 8% right now, on track for its biggest drop since April of last year. Operating income in the current period, $21 billion at the high end, below consensus. So the concern is the trade-off worth it here? There is a big backlog for AWS and AI business. By the way, it's one of the few names on the Nasdaq 100 that's down, because in reaction to that capital expenditures pledge, you see everyone from the GPU providers, NVIDIA's now up more than 6% in response, memory names, infrastructure names, energy names, all higher because the capital expenditures for all of the hyperscalers in aggregate plus Meta is growing. We're going to get to that with an analyst just a few minutes' time. In the world of cryptocurrencies, traders are buying the dip. Caro outlined it. Bitcoin's rebounding after plummeting on Thursday, erasing all the gains since Donald Trump's 2024 election, falling close to $60,000 popping back up again. Bloomberg digital finance reporter Emily Nicole joins us with the latest. Difficult. Emily, what's going on?
Your guess is as good as mine, to be honest. We've been watching Bitcoin over the last 24 hours, and it's really been a roller coaster. As you said, it dipped about 13% yesterday. Now I think we're up about 10%, so we're recovering some of that. But it's really just been a roller coaster week. It's been hard to kind of guess at why that's been happening. There's been a lot of instability over the last few months with geopolitical tensions, and Bitcoin's really struggled to patch onto any narrative within that, whether or not it's a safe haven, a store of value, if it can latch onto stocks as it used to trade pretty in line with tech stocks back in the day. None of that seems to be sticking, and it's just kind of doing its own thing right now.
FUD, some would call it, in the market. Fear, uncertainty, doubt just consumed the asset class as a whole, and it's consumed companies that have ridden so high on the back of the climb in crypto. I think of Strategy and some of these other digital asset treasury companies, DATS. How have you seen, particularly on the back of Michael Saylor's earnings yesterday, how have you seen people still questioning how long they can ride this?
Well, if we look at Strategy, for example, that has also had a similarly up-down 2 days. So yesterday it was down about 17% at the close before the earnings. Investors were really bracing for some bad news coming from that, particularly with Bitcoin having such a bad day. And then today we're seeing it up more than 16% because of that kind of whipsawing effect. The earnings weren't as bad as people expected. Losses were in line with what we thought was happening. No new debt was being created. And so people are trying to stretch for, where can we see some staying power within this rally? Where is there a bottom? Where is there stability? And that might be where we're now starting to see a sort of bottom. Maybe that 60,000 mark was it. And for Strategy as well, maybe it's kind of starting to see a way out of that.
Yeah, it's interesting, even with the headlines coming from China as they tighten curbs on crypto and on stablecoin issuance, still managing to catch some buying of the dip today. Bloomberg's Emily Nicole, what a busy week. Thanks for joining us. Meanwhile, let's talk Waymo now. Using DeepMind's Genie 3 AI model to create realistic worlds for a new Waymo world model. So according to the company in a blog post today, the self-driving tech developer argues this collaboration with another segment of Google's tech ecosystem is going to help the expansion of Waymo's self-driving services across many more markets. Ed.
Let's get back to Amazon. Big mover, big story. The stock lower as the company announced it's set to spend $200 billion this year on data centers, chips, and equipment, supercharging its bets on AI. Rohit Kulkarni is Managing Director, Senior Analyst for Internet and Capital Markets Research at Roth Capital Partners. they call it sticker shock, right? The reaction to the big capital expenditures number. But there was a time where a big capital expenditures number was what you wanted to see. Why the negative reaction?
I think the negative reaction is just because outside of the capex, people expected spotless earnings. I think capex sticker shock was expected given what Google, Meta, Microsoft did last 10 days. But what was not expected was slight yellow flags in operating margins, and suddenly people realizing that Amazon has to spend a lot more given they are launching satellites to space,
Right.
they are building new Whole Foods, and so on and so forth.
You have a buy on call on the stock, and I believe, let me just check here on my Bloomberg terminal. Yeah, $285 price target, right? There are lots of pieces of data in there. Some people looked at the operating income forecast for the current period and thought, that's a little worrying, bearing in mind AWS is the majority of operating income. Some looked at the backlog. Some looked at the AWS growth, 24%, fastest pace of growth in almost 3 years. Where would you look?
All of the above. There were many positives in the report and in the outlook and the various moving parts in Amazon. Accelerating AWS, improving retail margins, better advertising growth, as well as better efficiency in retail overall. I think what is spooking the market here is there are more investments beyond AI that this company is doing. Unlike many other peers that are just doubling down on simply one thing. So the worry here is next 2-3 years, how high of an investment curve are we looking at for Amazon, and what level of ROI do they get beyond the core AI investments? I think that's the worry here. But all in, we think this is a Gen AI winner, very underappreciated, and over time will tell.
Let's dig into why it's a Gen AI winner. Is it Trainium, Graviton, just seeing the triple-digit percentage growth, the fact that they've got that vertical integration, making their own chips, using that for the compute that they offer and the efficiency that it gains them? Is it more that their own models, like we don't talk much about the own models that they're producing. We talk so much about Google's, for example, but not so much Amazon's.
I know. I think Amazon is with all of the above. Again, they are vertically integrating in a way that absolutely no other company on earth is trying to replicate at the scale at which Amazon is trying to do. Vertically integrating cloud, vertically integrating retail, and having the diversity of advertising. So I feel when all three pillars of Amazon start to crank up higher operating margins, which we will see over the next, call it 6 to 9 months, that's when the real potential of profitability of this company will manifest in the numbers. And that's why I believe the surface area of investments as well as surface area of ROI on those investments is so much wider at Amazon. That is being underappreciated, and that's where we feel this is a Gen AI winner across the board.
It's interesting, we have such short-term memory loss sometimes. This was always a company that focused more on investing in itself rather than producing profitability. But push us forward as to how Andy Jassy continues to manage the cost basis, because that was the headline that stole the show previous to earnings season, was the amount of job cuts they're making. Is that still what you need to be seeing from Andy Jassy?
I think there is room. Probably the company needs to make, after the overhiring of almost 2.5 years after the COVID pandemic. I think there is still digestion period, but which probably one would argue that has been a little bit more prolonged than what one would have preferred to see. So I feel they're finally getting there, and I think a little bit of extra cost cuts would be much more appreciated to make room for more capex.
Capex across the hyperscalers plus Meta is now at $650 billion for the year. For Microsoft, that's based on consensus. The difference with Amazon is that they might tip into negative free cash flow. We have 30 seconds. How worried are you about that?
Not worried at all. This company has gone through negative free cash flow cycles in the past and delivered ROI, unlike many other companies that are for the first time going through this cycle. If you look at 15 years, Amazon has delivered ROIC probably in a best-in-class manner.
Rohit Kulkarni of Roth Capital Partners. Thank you very much indeed for joining us today. Now, coming up, we talk more earnings. We're speaking with the Roblox CEO, Dave Baszucki, as the company sees 144 million daily active users. You don't even want to hear how many hours people are spending on this platform. We'll break it down. This is Bloomberg Tech. Check out shares of Roblox. Company on fire, up 10% after they reported fourth quarter users and bookings that topped expectations. Daily active users jumped 69% to 144 million. It beat analyst forecasts. I'm pleased to say we're now joined on the results by Dave Baszucki, CEO of Roblox. Your engagement levels was jumping to a similar degree. I think it was like 68%. Is this the games that are driving this, Dave?
It's really the games, the platform, and the creator. You know, we are on a mission to get 10% of all global gaming content running on Roblox, and we're well on our way. We had a banner year, as you mentioned, in 2025. We had 55% year-on-year bookings growth. And in addition, as we started rolling out what we call the gold standard for safety, we're age checking our users, and we now have accurate data on the 18 and up segment, which is growing at over 50% year on year. In addition, around the world, countries like Japan are growing 160% year on year. Really, people are creating new genres and types of games, whether it was Dress to Impress a year ago or Grow a Garden. So we're powered by both platform and an amazing creator community.
Yeah, you've got Bruno Mars singing live on Brain Rot. I mean, 12 million people all using and coming to watch that at the same time. The records are interesting, given, as you say, these safety measures have been put in place. How has that impacted? Has that created any friction? Or indeed, it seems as though you're leaning into the opportunity of these safety measures.
I think leaning in is a good way to mention it. I believe the last time we chatted, we mentioned our vision for the gold standard for safety. In addition to filtering and monitoring all chat for critical harms and not allowing image or video sharing, we have now are full into our rollout of age estimation, which is understanding the age of everyone on our platform and using that to allow people to communicate with people of similar age. We gave our teams an ambitious goal to have no friction for this. And when you lean into something like this, a lot of innovations pop up on the side. Our matchmaking has gotten better. We continue to refine the way we filter text and make trusted connections. So we're optimistic we're going to go through this and ultimately come out with minimal friction from this.
Dave, I fired up my new gaming PC last night. Acer Nitro V15, Intel i5, NVIDIA GeForce RTX 4050. And I thought to myself, what am I going to play? And for you guys and everyone else, it's about pipeline, right? You rely on these third parties to keep the pipeline going, but you also have like the ambition on these higher fidelity games. How do you guarantee the pipeline, and how are you going to manage the pipeline going forward so I have some more things to play?
The pipeline on Roblox is very, very healthy. We watch the distribution, the variety, the diversity of the experiences that our creators are growing. And over the last year, we've made amazing, really advances, not just in our technology platform, but in search and discovery. So the pipeline is robust right now. We have a unique vision with our platform, especially for 18 and up expansion, that when a creator makes an experience on Roblox, it works at good performance on a low-end 2 GB Android phone, for example, but also can scale up and look beautiful on your brand new gaming PC. This is a unique technology. It requires a vertical stack going from cloud to game engine to discovery to the apps on everyone's desktop. It's why we're optimistic that 50% growth in 18 and up can get more and more of that part of the global gaming market. I'll highlight in the US, our ambitions are more than 10%. And in the US, a big majority of that 50 billion approximate gaming market is 18 and up. So we see really good trajectory in that direction.
Dave, advertising. we check with you regularly on it, and you're consistent that it's not yet a meaningful contributor, right? When will it be? Will it be? Or do investors now start to change how they factor in ads for you going forward?
I want to highlight the big picture. You know, in 2025, I believe we gave guidance in the low 20s, and we ended up with 55% bookings growth. So I want to highlight the big picture is we continue to exceed guidance and expectation on how we grow. We're seeing great progress both on rewarded video advertising and also developer-sponsored tile advertising, which is creators on Roblox who are monetizing really well, accelerating their own growth by purchasing advertising. We do believe it'll be a big segment. It will ultimately, as we roll out Roblox Moments, which is really used for discovery of video capture of Roblox, that'll be a part of it. So we're continuously bullish, but not ready to really split it out yet.
Dave, briefly, how bullish are you on the AI platform and indeed the model that you have? We've got Cube Foundation model that you've just unveiled, but Google's also got Project Genie. How are you seeing that changing the development of games, and how do you stick to your sort of more blocky aesthetic that people love?
Well, what we believe we will see over time as we advance AI, our avatar system, and our technology platform, a much bigger diversity of the types of experiences you see on the platform. We've shared our notion of novel games, which is games you'd never expected to see on Roblox in genres like RPG or in sports. And really with AI, we see that as an acceleration technology for both creation, for the way games look. We shared some videos on X this week around 3D in the cloud upsampling, and also how models will be used for driving creation. I'll highlight one key thing about Roblox. We are a connection and a communication platform. We're a multiplayer platform. We're, in sci-fi terms, we're building the holodeck where people go together. Some of the technologies out there that we're building as well, like world models, are currently video single-player technologies. We think the big long-term opportunity for us is synchronizing thousands of players in the cloud, which is much different technology and stuff where, is actively part of how we build Roblox.
Dave Baszucki of Roblox, thank you very much. Now, coming up on Bloomberg Tech, Affirm CEO Max Levchin joins us to talk about his company's results. Stick around, it's next. This is Bloomberg Tech. Shares of Affirm down about 6%. The buy now, pay later company reported results that beat analyst estimates, though some on the street say that the outlook part is a little bit conservative. Fortunately, we can talk through it with Affirm CEO Max Levchin. Actually, there's been a lot this morning about the outlook, the financials, strong quarter gone. I actually just want to talk about what you're doing. And I'd like to start, if I may, with the Affirm card. How's that coming along? And Max, with you, if I may, what's the end game with the Affirm card?
There is no end game. There's so much to do. I have a hard time saying we'll be done when this feature ships. Affirm card rocketed once again.
Yeah.
For a long time, I think it looked like a gently superlinear growth curve, and in our latest letter, we finally showed that it's...
That's kind of what I mean.
Yeah,
the trajectory's changed.
We didn't do anything very specific to make it go obviously exponential, but it is accelerating, and it's just the great work of our product teams that have been putting in new features, integrating all of our 0% deals into the card. The card grew, something like 4 times the rest of the business. It's just a rocket ship that we built a few years ago, and it just keeps going. The end game is to get you to put away your credit card forever and use a debit card powered by Affirm.
The other growth part of the story, because it is a growth story, and whatever you feel about the analysts saying you're being conservative, is international expansion a bit. So in my home country, in Caroline's home country, the UK, it's a really interesting case study. Yeah. How's that going? But then what comes next after that?
Well, we just announced some exciting brands. We're live with Shopify, our great partner in the US, now in the UK. It's a real business now. So for a couple of quarters, we said, look, we've crossed the pond. We're in London. we're hiring, we're building. It's now a business. It's making real revenue. It's generating some very significant sales lifts for our merchant partners. We have a whole slew of new partnerships to go live with soon. So feeling great about it, and eyeing continental Europe next, of course. And so we're definitely not going to be a North American phenomenon only, but we're still very, very committed and very focused on our North American stronghold.
So is TD Securities, is Truist, is Bloomberg Intelligence analysis right that you do guide conservatively and you just feel that that's the right thing to do in this consumer context?
I think the guide is the guide, as our CFO always reminds me to say. I encourage folks that hold our stock or eyeing our stock to see how we've done in the past, quarter after quarter. We make promises and we deliver on them. So we take our guidance very seriously. We intend to always do well relative to what we said we'll do and better. And that's what it is. I mean, ultimately, the results speak for themselves, and we are in it for a very long term. So at some point, people will figure out exactly just how much more growth there is in this business.
Credit quality holding up, clearly, and that's the litmus test in many ways for success within delinquencies. Are they on the rise? How are you seeing a consumer right now, Max?
We have underwritten tens of millions of American households in the order of 70 million, 26 million actives just last 12 months alone, we reported. We see a pretty big swath of America. Our consumer is healthy. They are paying us back. They're shopping. They had a great holiday season. A lot of outside observers underestimated our growth over the holidays. We proved them wrong yesterday once again. American consumer, as we see her, is doing just fine.
Max, I think this is the first opportunity we've had to speak since the president's initiative to cap credit card interest rates. We started this conversation by you saying, well, we want people to put their credit card away. You obviously have some bias in that narrative, but
Exactly.
Just your viewpoint on it, please, and what's happened in the weeks that followed. We just have 30 seconds, sorry.
I think the most important thing in this conversation about affordability is transparency. Like, rate caps are a conversation for the legislators, but the most important thing is people understand what they're getting into. The reason Affirm has been successful is because of upfront pricing. If you know what you'll pay, you'll be just fine.
Max Leishman, always great to have your transparency on the show, CEO of Affirm. Thank you. Coming up, we dive on this week's market moves with Lei Xu of AllianceBernstein. That's next. This is Bloomberg Tech.
Welcome back to Bloomberg Tech. We're looking at the NASDAQ 100, right? It's kind of the go-to index. It has the Mag 7, the kind of broadest and diversified list of tech companies. And on the week, we're headed for our biggest weekly drop since November. Caro pointed that out earlier. Actually, a percentage point more, and the NASDAQ 100 would be on track for its biggest weekly drop since April. In the moment, we're actually a little bit higher in this session, and that's the reaction of the supply chain to Amazon. And Amazon's projection of spending $200 billion capital expenditures in 2026. Of course, the big beneficiary when you're spending hundreds of billions of dollars on AI infrastructure and data center is NVIDIA, and that is one of the best performers right now in the session. If we move super fast, we might be able to change the chart and show you what that looks like. Boom, NVIDIA up 7%, Amazon down 8%. Actually, way more widespread than that across memory, chip equipment makers, nuclear names, the whole lot, Caro.
Power names, Bloom, its numbers extraordinary. Let's dissect this a bit more, Ed, because you've just been talking us through the sheer scale of the hyperscalers' plans. If you add in Meta, it's $650 billion. It really underscores just how quickly the AI race is accelerating. Let's talk more on what this wave of investment means for markets, for disruption across industries, for the actual use of the models that this compute brings. Lei Xu is with us, AllianceBernstein, CIO of Thematic Innovation Equities. You own the whole array. You own the hyperscalers plus the infrastructure layer. What from this week did you think? Do you agree that $650 billion is what we should be seeing from these sorts of names?
I think what we're seeing, and we've been saying this is the third year into, if you think about from the start of ChatGPT and where we are today, this is the third year into the build. And I would say this is the year that we should start to see adoptions. And in fact, I think that's what's causing a lot of disruption in the marketplace. We're seeing rapid model drops and launches of new models, newer versions of it, and the speed of that is accelerating. And that is something that we should be expecting to see at this point. But what's also interesting is that what it also means, and we said this is an interesting time. The large cap themselves, they're spending a lot of money because it's as defensive as it is offensive, right? It's for growth, but it's also to defend your competitive moat. AI has the ability to disrupt many models, and this time it's interesting is AI holds the potential to disrupt tech, how we think about the way that the infrastructure layer is and how we think about enterprise software, how the traditional business model with high competitive moat, how that could be changing going forward.
Yeah.
And that's exactly what we're seeing. So it's kind of hard for us to judge, is 650 the right number or is it a different number? Yes.
Can I jump in and ask, where do you look for the evidence then? So, for example, Amazon talked up its backlog, which is very different from RPO, right, in the world of software, because it's not invoiced. They talked about, the operating income. A backlog would suggest, oh my goodness, they've got hundreds of billions of dollars of revenues waiting in the wings from their AI offering. But the market doesn't seem to believe that. Do you believe that metric?
I think it's less about whether or not that is indeed just that one metric that we focus on, but rather, if you think about all these, this is basically a rebuild of the digital infrastructure layer. And that's why I said, what is 650 billion? Is that precisely the right number we should be anchoring on? But just the fact that how it could unlock the future of workload. And when we think about it, it's not just the hyperscalers per se, but also what does it mean for the rest of the economy? What could it unlock in terms of potential in productivity? And you're actually seeing the early evidence of that. You can see in the traditional retail industry, what does the future hold for shopping? And what does agent mean for future of shopping? Or if you think about the traditional manufacturing industry, we are in fact seeing real productivity gain from using AI, and that's only the beginning. And time and time again, I think if we look back in history, when you have such disruptive technology changes, what happens in the near term, some of the way that we do things gets disrupted. But then new business model, productivity gain, actually do emerge, and that is the power of innovation. It requires little imagination, so if you look at this point in time, yes, it's a huge number that we're spending, but you probably could look back, and back then when electricity was first invented, that probably was a tremendous amount of money to be spent on the grid.
Right.
What if this is the future of the grid?
Well, let's talk about, therefore, the innovation that we're seeing, Lei, at the moment. And I just want to bring to our viewers, of course, the latest that happened about midday yesterday when Anthropic released a new version of its AI model, Claude Opus 4.6. It's designed, we know, to carry out financial research, other work-related functions. The company says it can scrutinize company data, regulatory filings, market information, to come up with really detailed financial analysis that would normally take a person days to complete. This is after the market kind of fell out of bed following their legal plug-in to co-work. So how are you seeing these models becoming an entry point into software? What did you think about just the gargantuan sell-off across data services and software names?
It's in the time of such disruption, it's too early to call what's cheap, who is going to be the future winner, because this is only the beginning. And ultimately, it comes back to what is the real long-term competitive moat? And that's what the question really is at this point. Because, if you talk to the private companies, you probably are seeing some of the private companies, this is the fastest way for a company to get to $100 million revenue.
Yeah.
But my question would be, what is the real way to look at it? Who can hold on to that $100 million revenue for a long period of time?
Yeah.
And what we are seeing right now, what's interesting is, it's not in the near-term numbers that's going down. But the question that we are asking, and I think all the investors are asking, is, well, it brings in the probability of what is the terminal revenue we should be paying? What's the terminal multiple we should be paying for the revenue? Because the probability of holding on to that revenue and the profit is probably changing really fast. And that's why we're seeing the terminal multiple actually is coming down pretty fast. And that's the disruption that we're seeing in the market today. But with disruption and chaos, there's always opportunities. Because on the other side of it is, while we are really concerned about I feel like 6 months ago, everyone's concerned about the ROI. And now we're seeing models being dropped. And then in the meantime, there's a massive sell-off in the market. So I would think there's also opportunity as well, because now we're probably a little more comfortable with the ROI. And then the $650 billion question for everybody is, are we building a road to nowhere? And I would say, well, maybe there's hope that we're building a road to somewhere. So it actually creates huge opportunities if you have long-term horizon, and because there's dislocation in the market.
Lei Chu of AllianceBernstein, deeply pensive on what's happening in the markets, long-term and short-term. Thank you so much. Now, coming up, we're joined by Warner Music Group CEO Robert Kyncl to break down the company's earnings. That conversation next. Don't miss it. This is Bloomberg Tech.
Cue the upbeat music. After record quarterly revenue in fiscal fourth quarter, Warner Music Group rose another 10% in its first quarter thanks to increases in digital, in artist services, and expanded rights and licensing revenue. And they're leaning into AI. The shares are up 5% on the day. As you can see, let's talk it through with the CEO, Robert Kyncl. Thank you very much indeed for joining us today, Robert. And you talk about the creative wins here. So is it the force factors of Alex Warren, of Cardi B, of Ed Sheeran that drive these sorts of revenues, or where else are you managing to pull the levers?
First of all, thank you for having me. It's really great to be here to talk about the success that we're seeing with our strategy working. You're leading it with the right way, which is artist development is at the core of what we do. And finding artists like the ones you mentioned is how we succeed. But it is not just that. Our market share growth has been broad-based across regions, across business units. So both our catalog division as well as our frontline divisions, North America, Latin America, Europe, have been growing and gaining share. And that is what underpin our consistent results, over the past 3 quarters of driving sustained growth and acceleration while we're cutting costs.
Cutting costs. How much are you able to cut costs with AI? Because, Robert, herein lies your background, the fact that you've worked in always with a focus on digital, the intersection of music with technology, and the fact that you have led the charge, striking deals with Suno, for example, putting out blog posts as to why this can be a win for the artists you develop. How much is that actually helping cut costs at this moment?
Yeah, so it's good to step back on AI because the way we approach it is that it has to deliver against our 3 core priorities. Priority number 1 is growing our share. We just spoke about that. And there are activities that we do within that using AI that help us automate our marketing across our entire catalog of over 1 million songs. It is humanly impossible to touch all of those songs and promote them. With AI, we can do that. And we're well underway to delivering on that. So it's a major accomplishment for a large IP owner such as ourselves. 2, we have to increase the value of music. And AI is helping us to do that by introducing new pricing tiers on existing DSPs, digital service providers, but also by having new entrants such as Suno and Udio. And that is where we focused initially. And we want to make sure that now we're not only getting paid from consumption, from the Spotifys and YouTubes of the world, but also from creation, from the Sunos and Udios of the world. And those 2 worlds over time will merge as well. And then third is growing our efficiency. And on the efficiency front, we're deploying AI across finance, across legal, across HR. These are 3 departments that we started with, obviously in addition to marketing that I mentioned before. And all of that is helping us be more effective, handle more copyrights and more artists at the same or lower employee base, and at the same time grow revenues and profit.
Robert, we got some early insight into what your strategy is when you joined us at Bloomberg Screen Time, right, in October. And my interpretation of your time on stage was that this was pretty early, like Suno is a case study. Now that we're a few months on, are there any examples of work you've deployed either internally or work you've done with Suno and the 4 or 5 other companies that you've done deals with that's new, that's tangibly made an impact in the quarter gone?
Yeah, so actually when I was with you guys, at your conference in October, we were actually heads down on deals with those companies. So those were not even closed. So it was super early. I've published principles that we as a company uphold to doing these deals, which is the partners have to commit to licensed models. They have to properly reflect the value of music, which means the right commercial terms that we're really happy with. And three, that artists have to have the right to opt in for the use of their name and likeness in in derivative works. And we're in the process of transitioning these partners to licensed models. So the answer to your question is not yet, because we're extremely early in that, but they're well underway. They're signing more partners, and they're working on their new models. And as soon as they transition to licensed model, which is our condition number one, then we will be able to start cooperating much more deeply.
We just had the Grammys, right?
Yeah, I mean,
sorry, Robert, let me just jump in. We just had the Grammys, and that puts the focus back on the artists, the songwriters, other side of the table. How have they responded to your strategy and the work you want to do with the AI companies?
It's been fantastic. We as a company take our role of guiding the development of AI in music very seriously, because we've learned from the past where the music industry waited for far too long during the file sharing era 25 years ago. So we believe in being early, taking the reins together with our partners and defining the future of music. And there are a lot of artists who want to be part of that. They also have learned, they studied the past, and they want to be part of it. So we are having conversations both with our artists, their lawyers, their managers, and there are many artists who are reaching out and they just want to be part of experimentation with us. So it's been a surprisingly positive response.
I mean, it was a positive day for you with the Grammys as well as some of your R&B wins, for example. I'm interested about the joint approach briefly that you're doing with Bain, because it feels as though you think the value of music is going up if you're wanting to be buying these back catalogs even more so.
Yeah, so we firmly believe that music is undervalued. It's undervalued. It's roughly 50 cents of value of a video, and it shouldn't be based on its consumption. It's just for historical reasons. So there's tremendous opportunity for value appreciation in the future. And we believe that the industry is finally moving from just volume-based, subscriber-based growth to volume-based and price-based growth. And that's really important. We started on this strategy over a year ago, where we started to retool our partnerships with our distribution partners to have certainty around our wholesale rate increases, rather than hope and wait and welcome price increases, which we always do welcome, but we're really focused on creating certainty around rate increases overall. So in the face of that, and with the added step change of value caused by AI and additional tiers, companies, experienced investors like Bain see this as something that has potential to really unlock a lot of value in the industry, and they're putting their money where their mouth is.
Robert Kyncl, CEO of Warner Music Group. Great to have you back with us on Bloomberg Tech. Really appreciate it. Thank you. Let's turn back to the earnings story elsewhere. Shares of Reddit actually now softer, 0.4%, basically flat. One point in the session had been up 8%. So we kind of fizzed out a little bit. The company projected current quarter sales that did surpass Wall Street's expectations thanks to growing ads. Its advertising business. Get out to Bloomberg's Kurt Wagner. What's going on with the Reddit story here? I just got an analyst note in my inbox saying that Reddit's on a roll, but the stock would suggest otherwise.
Yeah, when it started up this morning, that made sense to me because, as you pointed out, Ed, the projections for the current quarter were good. There was a big beat in the holiday quarter. It feels like there's a lot of momentum for this advertising business. I think they have an AI story to tell, too. They're obviously not building these massive data centers like we're seeing from these hyperscalers. They're not having this massive capex, but they have this product called Reddit Answers, which is basically an AI search engine built into Reddit, and years and years and years of forums of people discussing things. And they are also licensing that data, as you know, to some of these AI players. So they have a bit of an AI story that isn't quite as capital intensive as a lot of these other big tech players coming down.
It's interesting, the analysts said many had reiterated their overweight, some neutral, but Piper Sandler, Cantor Fitzgerald, we're also seeing Baird cut their price targets. So maybe there's a little bit of a view on how much what's already priced in, Kurt. What was really interesting, I thought, was the international growth here. And is that so much to do with the AI and the translation capability now?
Yeah, I think they've been working to make sure that it's accessible to people who don't just speak English. This is a lot of these consumer products, as you both know, as they grow, they have to build their product for all of these various markets, and that does take time. I think that's part of it. One of the things that's interesting, you'll see in some of these analyst notes of this debate around logged in versus logged out users. If you guys remember Twitter back in the day, this was the big debate. Could you show ads to someone showing up to Twitter who doesn't have an account? I think Reddit's in a better position because of the focus of these forums and being topic-based.
Bloomberg's Kurt Wagner, all over social media as always. We thank you. Ed, what have we got coming up?
We've got the Boring Company going full speed on a tunneling project in Nashville, but there could be some headwinds along the way. Bloomberg Big Take coming up. This is Bloomberg Tech.
Tesla is evaluating multiple sites across the US to manufacture solar cells as part of Elon Musk's 100 gigawatt solar ambition. It's all according to sources. Now, the company is considering expanding production at its Buffalo, New York factory, with Arizona and Idaho also under consideration. But longer term, another scenario would involve building a second facility in New York State, one source said. China currently dominates output of solar cells. And Ed, on the back of your scoop, you've seen some big share price moves.
Yeah, and his other companies are busy too. The Boring Company is about to embark on its most ambitious tunneling project yet, its first full-fledged transit corridor underneath Nashville. But critics worry the company is winging it. Bloomberg's Kyle Porter is here with the details in this week's Bloomberg Big Take. It is the most ambitious project that Boring has undertaken, but people are worried. So balance those two things. Why is it the most ambitious and what's the concern?
Well, it's the most ambitious on several levels. Boring that is, are looking to build 2 10-mile tunnels between the airport and downtown Nashville, and they're looking to do it through limestone, which is, compared to other projects such as the Las Vegas one, they're running through sandstone predominantly at that point. Getting through limestone is very tricky. You have the risk of things like sinkholes. It's a very heavy, wet rock. Like actually transporting it through out is going to be incredibly difficult.
That's some of the technical difficulty. I mean, your big take was so eye-catching simply because of the headline. Musk's Boring Tunnel in Nashville has mayor hoping no one dies. Just how realistic are they worried that that's some sort of opportunity cost here?
Well, if you read the story, the city have largely been cut out of this entire process. Having been involved at the start, they felt that it wasn't the right time, depending on who you talk to, and people around Boring say they just weren't interested. So they went, and the entire route now has been designed to go on state land. So until you get to things like fire safety and like really into the construction process and looking at things like egress points where emergency services could get in if there's a problem in the tunnel, the city don't have much say. So the mayor, depending on your point of view, is either being alarmist or is just expressing concern on behalf of his constituents.
You've been reporting on Boring deeply for a little while now, and the timing of the big takes are interesting because also the company's looking to the Gulf, right? What can you tell us about Dubai and their international expansion?
Dubai is the first successful contract signed for an international expansion. They're looking at putting multiple exit points in to that network. Our understanding is that they may have already sent a test vehicle out there, though we've not been able to confirm that yet. Again, it's a very aggressive timeline for getting these things done. If you look at the Las Vegas project, I believe they started tunneling there pre-COVID, and there was supposed to be 68 miles worth of tunnels dug by now. I think they've got 5 miles operational. So either they've dramatically improved the machine and their processes, or it's not going to go as quickly as they're saying.
Bloomberg's Kyle Porter, deeply researched story. We urge people to go and read it. Meanwhile, that does it for this edition of Bloomberg Tech. What a week, Ed.
Yeah, it's like the mic drop week for capital expenditures. 185 billion Alphabet, 200 billion Amazon. The repercussions next week. Recap on the pod. You know where to find it. It's there on the screen. And this is Bloomberg Tech.